There's a quiet conversation that happens at kitchen tables across America when a retiree makes the final mortgage payment. The relief is real. The pride is earned. 30 years of disciplined payments, extra principal when the budget allowed, the refinance that saved a quarter point back in 2012. And now the deed is clear. The home is yours in the truest sense. No lender looking over your shoulder. No monthly payment carved out of your Social Security. Just a paid-off roof and the wind in the trees. Most retirees believe that once the mortgage is gone, the IRS no longer has any interest in their home. They believe the house is outside the tax system. They are wrong. The IRS has specific expectations of homeowners at 65 and beyond, expectations that can trigger penalties, missed benefits, and surprise tax bills that erase some of the peace of mind that comes with owning free and clear. Most retirees never hear about these expectations until a tax letter arrives or a missed filing creates a problem that takes months to unwind. This video walks through what the IRS still expects from you after the mortgage is paid off and what you can do about it before the next tax cycle begins. This video is for educational purposes only and is not personalized tax, financial, or legal advice. Consult a qualified professional for guidance on your specific situation. Real estate tax rules involve both federal and state provisions, and your specific situation depends on your state of residence, your income, and the specific characteristics of your property. I will cover general principles that apply broadly and highlight specific forms and provisions to ask about. Let me start with the expectation most retirees miss entirely. Even after your mortgage is paid off, you are still expected to properly report your home in several ways on your tax return, and you're still subject to federal and state rules that can create tax consequences around your home. First, property tax is still deductible if you itemize, subject to the state and local tax cap of $10,000 per year under current law. Most retirees with paid-off homes no longer itemize because the standard deduction for couples over 65 is generous enough that it outperforms itemizing for most middle-class retirees. But in states with high property taxes, such as New Jersey, Illinois, or California, itemizing can still make sense, and forgetting to track property tax payments can cost a retiree several $100s in missed deductions. Second, if you sell the home, you are subject to the Section 121 exclusion and the tracking rules that go with it. The exclusion allows up to $250,000 of gain per single filer or $500,000 per joint filer to be excluded from income when you sell your primary residence, provided you have owned and used the home as your primary residence for at least 2 of the last 5 years before the sale. That sounds simple, but the gain calculation is not. Your gain is the sale price minus your adjusted basis. Your adjusted basis is your original purchase price plus qualified improvements, minus any prior depreciation if the home was ever used for business. Improvements count. New roofs, additions, kitchen remodels, new HVAC systems, and other substantial improvements add to your basis. Routine repairs and maintenance do not. If you have owned a home for 30 or 40 years and made numerous improvements, the difference between tracking your basis and not tracking it can easily be $100,000 in taxable gain. Consider James. He bought a home in suburban Detroit in 1985 for $92,000. He paid it off in 2015 after 30 years of payments. Over those 30 years, he put on 3 new roofs, replaced the HVAC system twice, added a 3-season room, remodeled the kitchen and 2 bathrooms, finished the basement, and replaced the driveway. Total documented improvements, based on receipts he saved in a shoebox in the basement, came to approximately $115,000. In 2024, James and his wife, Eleanor, a retired elementary school teacher, sold the home for $620,000. Without tracking improvements, their gain would have appeared to be $528,000. With the $500,000 joint exclusion, they would have owed capital gains tax on $28,000 at the 15% federal rate, or about $4,200 plus state tax. But with the documented $115,000 in improvements, their basis climbed to $207,000, making their gain $413,000, fully covered by the exclusion. That shoebox saved them over $4,000 in tax, not to mention preventing a potential IRS surcharge 2 years later. Most retirees do not keep good records of their improvements over 30 years. The IRS generally expects you to be able to substantiate your basis with receipts or other documentation. If you are selling a long-held home, go through whatever records you have, reconstruct what you can, and ask a tax professional what level of documentation is acceptable for your state and situation. An oral history is not enough. A folder of receipts and a spreadsheet of dates and amounts is a reasonable minimum. The third expectation the IRS has at 65 is that you notify them if you change your address. Form 8822 is used to update your address with the IRS. It is your responsibility to file it. If you sell your home and move to a new state, or move into a smaller place, or relocate to be closer to family, you need to file Form 8822. Otherwise, IRS correspondence goes to the old address, and you may miss important notices, including notices of additional tax due or refunds that are in transit. Retirees who move and do not update their address can find themselves chasing down a letter that was returned to the IRS as undeliverable, often after the deadline for response has passed. The fourth expectation is that any rental use of your home creates tax obligations. If you rent out your home even part of the year, perhaps as a snowbird renting out your primary residence while you live in a winter place, you may trigger a filing requirement and lose a portion of your Section 121 exclusion on a future sale. The rental portion is treated differently for tax purposes. Even renting out a single room on a home sharing platform for a few weeks can create complexity. If you do any rental activity, keep careful records and consult a tax professional before your next filing. The fifth expectation relates to home equity loans and lines of credit. Many retirees take out a home equity line of credit at some point, either to fund a major improvement, help a family member, or cover an unexpected expense. The interest on home equity debt is only deductible if the debt is used to buy, build, or substantially improve the home itself under current tax law. Interest on a home equity line used to pay off credit cards or fund a vacation is not deductible. This is a change from pre-2018 rules that allowed broader deductibility, and many retirees still assume their HELOC interest is deductible when it is not. The sixth expectation is around reverse mortgages. A reverse mortgage is a loan against your home equity that allows you to access cash without selling the home, and repayment is deferred until the home is sold or you pass away. The proceeds are not taxable, but there are specific rules about how the debt interacts with your estate and how any eventual sale of the home is taxed. If you have considered a reverse mortgage or have one in place, the interaction with your other retirement accounts and your eventual estate is more complex than most advisors acknowledge. Seek specialized guidance. The seventh expectation, often overlooked, relates to property tax and state benefits available to retirees. Many states offer a property tax exemption or a reduction for homeowners 65 and older. These exemptions can save hundreds to thousands of dollars a year, but they are not automatic. You must apply for them, usually at your county assessor's office. The deadlines and documentation requirements vary by state and county. A retiree who owns free and clear but has not applied for the senior exemption in their state is paying property tax they could legally avoid. Let me give you a specific example. Margaret moved from Cleveland, Ohio to a small community in Florida after her husband passed away. She was 70 at the time. She owned her Florida home free and clear, purchased with proceeds from the sale of the Cleveland house. She paid property tax of about $4,800 a year for 3 years, before her new neighbor mentioned the Florida homestead exemption and the additional exemption for seniors and surviving spouses. Margaret applied, qualified, and saw her property tax drop by about $900 a year going forward. She also filed a late application in one county that allowed her to recover a portion of the previous year's tax. Over the remaining years of her retirement, the senior exemption will save her thousands of dollars. All she had to do was apply. The county was not going to volunteer the benefit. An eighth expectation is around estate planning and the step-up in basis at death. If your home is in your name and you pass away, your heirs receive a step-up in basis to the fair market value of the home on the date of your death. This effectively erases the capital gains that accumulated during your lifetime and can save your heirs significant tax when they eventually sell. This is one of the most valuable features of the current tax code for retirees who own appreciated property. Converting your home to a trust, gifting it to your children during your lifetime, or other transfer strategies can inadvertently forfeit the step-up. Before doing any estate planning involving your home, confirm with an estate attorney that you are not giving up the step-up in basis. A ninth expectation involves the interaction between your home and Medicaid planning, if long-term care becomes a concern. A home that is owned and occupied is generally treated as an exempt asset for Medicaid eligibility purposes, with state-specific equity limits. But after Medicaid is paid for nursing home care, states have the right to place a claim against your estate, which can include the home, through Medicaid estate recovery. Planning around this is delicate and state-specific. A conversation with an elder law attorney is often warranted. A 10th expectation, quieter but important, is that if you have a second home or vacation property, the tax treatment is different from your primary residence. Second homes do not qualify for the Section 121 exclusion on sale. Rental of a second home for more than 14 days a year triggers rental income reporting. Mortgage interest on a second home has different deduction rules. Property tax on a second home counts toward the $10,000 SALT cap, along with your primary home property tax. Many retirees accidentally blur the lines between primary and secondary homes in ways that create tax complications. Let me walk through what a free and clear homeowner should actively do each year at tax time. First, keep track of property tax paid. Even if you will use the standard deduction, having the number on hand is useful for state tax returns and for tracking your cost of homeownership. Second, track any improvements made during the year. Keep receipts, date them, note the type of improvement, add them to a running basis file. Third, if you have made any rental or business use of your home, track that activity carefully. Even minor business use, such as a home office, has basis and depreciation implications. Fourth, review your senior and homestead property tax exemptions annually to make sure you are receiving them. Fifth, update your address on Form 8822 if you have moved. Sixth, confirm your beneficiary designations on any retirement accounts linked to the home and make sure your will or trust properly addresses the home. Seventh, review your title. Some retirees hold title in ways that create complications at death, such as sole ownership, when a joint tenancy or a transfer on death deed would be cleaner. Let me also cover a specific trap around property tax assessment appeals. Many counties reassess property values periodically, and the assessed value drives your property tax bill. If your county reassesses and you believe the new value is higher than market value, you have a right to appeal. The process varies by jurisdiction, but the deadlines are firm. Missing an appeal window means paying the higher tax for the entire year. Retirees sometimes receive the reassessment notice, set it aside to deal with later, and miss the appeal deadline entirely. For a home valued at $500,000 in a county with an effective tax rate of 2%, an overassessment of 10% means the owner is paying roughly $1,000 more per year than they should. Another trap involves disability or veteran exemptions. In many states, additional property tax relief is available for homeowners who are 100% service-connected disabled veterans, or for surviving spouses of veterans, or for homeowners with certain disabilities. These exemptions can eliminate most or all property tax for qualifying homeowners. They are not widely advertised. If you or your spouse served in the military, or if you have a qualifying disability, check with your county and state for any exemption you might be entitled to. A third trap involves transferring a home to children or a trust during your lifetime without understanding the tax consequences. A direct gift of a home to a child uses part of your lifetime estate and gift tax exemption and transfers your basis to the child, meaning the child loses the step-up in basis they would have received if the home had passed through your estate at death. A transfer to a revocable living trust does not affect the step-up. A transfer to an irrevocable trust may affect the step-up depending on the trust terms. These distinctions matter enormously and should never be handled without attorney guidance. Let me tell you about Arthur and Nancy, who retired to Asheville, North Carolina from Ohio. They owned their Asheville home free and clear and had carefully tracked improvements over their years of ownership. And when Arthur began to experience serious health issues in 2024, their son suggested they transfer the home to him to simplify eventual estate handling. A well-meaning suggestion. But an estate attorney intervened in time and explained that such a transfer would strip the step-up in basis that their son would otherwise receive at Arthur's death. Instead, the attorney recommended a transfer on death deed, which allows the home to pass directly to the son at Arthur's death while preserving the step-up and avoiding probate. Nancy and Arthur updated the deed. The son will inherit the home with basis equal to the fair market value on the date of Arthur's passing, potentially saving him tens of thousands of dollars in capital gains tax when he eventually sells. The broader lesson is that owning your home free and clear does not remove you from the tax system. It simplifies your finances, reduces your monthly cash flow burden, and gives you flexibility. But the IRS, your state, your county, and your heirs all still have stakes in how your home is treated. The expectations continue past age 65, past the last mortgage payment, past the milestones that might feel like completion. Awareness of those expectations and careful record keeping are the practical tools that protect the equity you built over decades. If this video has been helpful, consider following the channel for more practical retirement content that goes beyond the surface level advice you hear everywhere else. I try to cover the specific situations that most retirees actually face with the specific forms and deadlines that matter. In upcoming videos, I will be digging into the interaction between home equity and long-term care planning, the specific tax treatment of selling a home at a loss, and how downsizing decisions affect your overall retirement tax picture. If you have a specific question about how your home interacts with your retirement taxes, drop it in the comments. I cannot give personalized advice, but I may be able to address the general topic in a future video that helps many retirees at once. Take care of the home you worked hard to pay off, and take care of the tax planning that goes with it. The equity is yours, the paperwork is yours, and the savings from doing it right belong to you and your family for years to come.